Hey everybody, it is Crypto Quantamental, and today we're going to be talking about beta. Beta is an incredibly important risk metric that anybody that is in the markets should know and understand how to calculate. Now, you're going to come across beta whether you're still in school, studying for, say, a finance major or a business major, or if you're studying for this CFA exams, or perhaps you're already in the markets and you're trading and investing. You need to understand beta and how it relates to your portfolio. So let's jump in here. So beta is a measure of risk. It, in particular, is a measure of systematic or market risk an asset has. What it is not, it does not measure individual asset-specific risk or idiosyncratic risk or unsystematic risk. For example, if something in particular happens to one asset, like say it gets a major litigation event, or a CEO suddenly retires or something like that, that one event is very idiosyncratic and is not related to beta. Beta is how much market level risk that you are taking. Beta is going to be reported as a number centered around 1, and 1 would equal that you have the same risk as the market. If your number is greater than 1, then it's riskier than the market. Less than 1 would be less risky than the market. So there's 3 standard ways to calculate beta. You can actually get to it in other ways as well, but I'm going to talk about these 3. You can see in the bottom right hand corner here I have a little legend here so you can see some acronyms. So the first method here is utilizing covariance and variance, where you simply take the covariance of an asset in a benchmark and divide it by the variance of the benchmark, and that'll give you your beta. The second way is utilizing correlation to standard deviations, where you take the correlation of an asset in a benchmark and you multiply it by the standard deviation of the asset divided by the standard deviation of the benchmark. Now, I'm saying asset here, but this could be a portfolio, it could be a stock, it can be a cryptocurrency, it can be a standard currency, a commodity. It doesn't matter. It's just one particular asset, and the benchmark is what you're trying to beat or comparing against. That can also be another portfolio, the S&P 500 as an example, or it can actually be another stock. It can be a variety of different things. However, the benchmark is generally what you're trying to achieve or trying to beat. And the last way here is through the regression. The formula here would be the standard CAP-M. So if you're in school or you're studying for the CFA exams, you would know the CAP-M pretty well, and that's what you see here. And frankly, honestly, it's easier than it looks. You're just running a regression as with the assets returns as the Y variable and the benchmark returns as the X variable, and the slope of that line is your beta. As simple as that. If you want to be pure to the CAP-M, which I'll get into later, you would want to subtract out the risk-free rate from both the benchmark and the asset. And the risk-free rate you can think of just, say, as treasury bills. And the key here is all 3 ways will give you the exact same answer, provided you do the same thing in terms of the risk-free rate across the board, as in subtracting it out or not subtracting it out. But regardless, it'll give you the exact same answer as long as that risk-free treatment is the same, and that's the key. So it doesn't matter which way you do it, you're going to get the exact same answer. And honestly, it allows you some great flexibility, because if you have beta, you're able to potentially calculate a variety of other things, given what else that you know, because these formulas are very interchangeable. So what about beta versus volatility or standard deviation? A lot of people talk about standard deviation, which is an incredibly important risk metric by itself. Now, the key difference is beta accounts for co-movement or correlation. So how the two assets or the asset and the benchmark relate to each other is incredibly important. So if there's no correlation, then the beta will always be 0, even if they have the exact same standard deviation or volatility. And you can see why in this formula here. If the correlation is 0, then whatever the standard deviations are is immaterial because you're multiplying it by 0. So that is why it's incredibly important to select a good benchmark. Having a low beta doesn't necessarily mean you have a low risk asset or a low risk portfolio. It means that the systematic risk related to the benchmark that you've chosen is low. Okay, so that's very important. If your asset is not related to your benchmark, then your systematic risk related to that benchmark is going to be very low, of course. So it's incredibly important to select a good benchmark in order to get a good measure of market-related risk. I put a little tip here. If the correlation is less than 0.85, you maybe try to select a better benchmark. That's just a rough number. You could probably get away with 0.8 as well, but generally what people look at would be the R squared, which is the correlation squared. If that's less than 0.7, then that's generally a bad sign that your benchmark is not really reflective of what you're trying to accomplish. So let's talk about an example. So assume your portfolio has a beta of 0.7, so you're a low beta portfolio. You have lower market sensitivity than the benchmark. So let's say the market or the benchmark goes up 10%. What is your expected return? Assuming 0% is risk-free rate, just to keep the math simple, your expected return would be 7%, basically simply as 10% times 0.7. Simple as that. So let's say the benchmark goes down 5%. What is your expected return? Minus 3.5%. Because you were low beta, you don't have as much market sensitivity as the benchmark. And any return above 7% or below 7% for the first example, or minus 3.5 for the second example, would be considered alpha or manager skill. So in the first example, say you returned 8%, how would that be interpreted? Well, 7% of that would be due to the market, and 1% would be due to your skill or your alpha. Now you would still underperform the benchmark by 2% because you only return 8%. However, you would have an alpha of 1% because your risk policy of 0.7 only had an expected return of 7%. So that's why it's very important to risk adjust these things so you can get a good sense of what the alpha or the manager skill or portfolio skill actually is. So let's talk about some good practices. One would be to know the beta of your portfolio. In order to do this, you got to have a benchmark. As I've mentioned quite a few times, benchmarks are critically important. And it also requires tracking your returns of your portfolio, whether it's daily, weekly, monthly, however you want to slice and dice it. You need to know those returns over those frequencies. And then going with point number 1, it's nice to know whether your portfolio beta is consistent. If your strategy is having your beta bounce around, that could be a red flag potentially, or it could be intentional, but you should know your beta and whether or not it's moving. And then you should have an idea where you want your beta to be. So if you want to be riskier than the market and have more market sensitivity than the market, then you can aim for a beta greater than 1. If you want to have less market sensitivity, then you can aim for a beta lower than 1. It's also good to have an idea of the betas of each asset in your portfolio. And the reason is because then you can get a good sense of if you bought the stock or this currency, is this going to increase your market sensitivity or is it going to decrease it? Are you going to get more Are you going to add more market risk to your portfolio or decrease it? And in order to do that, you need to have a general idea of the betas of each asset. So let's learn how to calculate it by hand. I know I tossed in the few formulas a few slides ago, briefly went over it, but let's jump into my free tool spreadsheet and you guys can get your hands dirty here. All right, so let's take a look at this Google Sheet. The link is in the description of the video, and this should teach you guys exactly how to calculate beta. So in column A, we have monthly data points, 1 through 36, but the reality, these could be weekly data points, these could be daily data points. I mean, generally, you want at least more than 30 data points, whether you're looking at days, weeks, months, etc. Columns B and C would be the asset return, and then the benchmark return for each of those 36 periods. So method 1, utilizing covariance and variance, which is simply the covariance on top of the variance of the benchmark. So let's calculate the covariance. Here, this looks pretty complex, and the reason is Google Sheets doesn't have sample covariance, which I'll get to in a second, but we want to use sample instead of population. So just keep that in mind. So I had to calculate the population covariance and then convert it to the sample covariance, which is just some basic algebra. The variance, so I'm doing the sample variance. You can see the point S here, that signifies sample, and I'm doing that of the benchmark over the last 36 periods. And the beta is simply division of the two. And you can see it is 0.7464. Method 2, using correlation and standard deviations. Let's just get the simple correlation between the asset and the benchmark. See that here? The correlation is 0.9178, so fairly high. The standard deviation of both the asset and the benchmark. Here again, you can see the point S. I'm getting the sample standard deviation for the asset. And then the same thing for the benchmark. You can see the asset and the benchmark standard deviations here, where the asset has a lower standard deviation than the benchmark. If you actually divided them, you could see it's about 0.81 or 81%, that ratio. And if we did the beta formula here, correlation times the ratio, you get the beta. So the key thing here is the ratio of the standard deviations is actually higher than the beta. Why? Because the beta is accounting for the co-movement in the correlation. Then lastly, if we did a regression, which both Excel and Google Sheets can do pretty easily, but it's pretty handy. You can get a variable within a regression really easily through a formula called slope. This is just the beta coefficient in the linear regression. So I just identified the y variable and the x variable. The y would be the asset and the benchmark 3, and get the slope. And this is using the regression methodology. As you can see, they get the same exact beta perfectly for each. Now, I put a little box here about sample versus population. That's well beyond the scope of this video, but in order to get all three methodologies to be the same, you need to use sample covariance, sample variance, and sample standard deviations, not population. Honestly, that's what I use all the time anyways for beta calculations. I believe that would be best practice. And then lastly, what about the risk-free rate? I have another box over here. I'll kind of highlight it for you guys. Feel free to read that. So the question is, do you want to subtract it out? Do you not want to subtract it out? Generally, if you're doing the regression form, most people would, because that's the CAPM. That is what won a Nobel Prize, so it's kind of industry practice. However, a lot of people, if they're using the covariance or the correlation, two formulas here, they would not subtract it out. But the result there, you'd have different betas, so you have to be consistent across the board. So I'll show you both ways. Here would be if we did not subtract it out. If you subtracted out the risk-free rate, get another tab here, and I just have column B here with the risk-free rate pretty low here. I have it steadily increasing. This is monthly frequency, so the returns are pretty low. And the exact same formulas go right through here, and you can see the beta is actually slightly different than before. 0.7455 versus 0.7464, so it's ever so slightly different if you subtract out the risk-free rate. However, if you go back to the 70s, 80s, 90s, etc., higher risk-free rates, it would make a much bigger difference. So right now, the treatment's not as important as long as precision is not a major priority, but it could matter if interest rates go up quite a bit. All right, guys, let's just jump back here to this presentation. That pretty much wraps it up. If you enjoyed this video, please subscribe to my channel here and follow me on Twitter at CryptoQF. Hopefully, this helped you a little bit for whatever you're trying to achieve, whether it's an exam at school or the CFA exams. Good luck on that. Those are definitely a challenge. But even if you're just a trader or investor, it's very important to understand how much market risk you're taking. So if it helps out, definitely like and comment on this video. And safe trading and safe investing out there, guys.